Stop everything right now because what I'm about to tell you changes the game so fundamentally that if you don't understand it in the next few minutes, you're going to be left behind in the ruins of the old economy. It's January 19th, 2026, and while you were sleeping, a government mineral assessment just dropped that confirms the beginning of the end for the global silver pricing system. This is Market Pulse USA, and you're probably looking at your screen seeing paper silver hovering around $93. You're seeing futures contracts traded at one price. You might think that's the story, that the screen price is what matters. You're dead wrong. That's just background noise. That's just the symptom of a broken market. The real story is that a new player just entered the chat with a printing press that can print infinity. We're talking about a 2 billion ounce silver deposit sitting in the Arctic that nobody's talking about yet. We just got confirmation of a massive, unprecedented shift in how nations are competing for critical minerals. Buried inside a US government report on mineral resources is data that should send chills down every trader's spine. The United States government officially confirmed discovery of massive silver concentrations in northern Greenland. The estimate they released shows approximately 2 billion troy ounces in a single Arctic deposit. Let that number sink in, 2 billion ounces. Now, in the context of annual global silver production, that might sound like a lot. Actually, it is a lot. You're not missing anything. That's the entire annual production multiplied by 2.5 years sitting in one Arctic location. The entire annual production of investment-grade silver gets dwarfed by this discovery. At current prices, $2.5 billion in market value would represent controlling supply for years. But it's not just the size, it's the strategic location and the mandate behind it. When miners discover silver, they're profit sensitive. If it costs too much to extract, they slow down. They've got budgets and engineering constraints limiting their moves. But when governments realize critical resources sit in contested zones, money becomes irrelevant. They don't care if it costs $1 billion to build infrastructure. They don't care if it's $5 billion. They don't care if it's $50 billion to develop the mine. They've got a mandate to secure the metal because without it, their defense systems go dark. Without it, their renewable energy transition collapses. And without it, they become dependent on rivals who control Arctic access. This is the moment we've been warning about for years on this channel. We told you eventually silver would stop being treated as a commodity. We told you it would start being treated as a strategic imperative. We told you eventually superpowers would fight for control. And that fight just went from theory to reality. Think about the timing carefully. Why now? Why, on January 19th, 2026, does this assessment suddenly get released publicly? Because nations around the world have seen the same data. They know Arctic shipping lanes are opening. They know technology demand for silver is exploding. They know whoever controls Arctic resources controls the next decade of power. So they're positioning, but not in a healthy market full of supply. They're positioning in a market already showing signs of terminal shortage. Imagine a chessboard with one critical piece everyone needs. 10 players suddenly realize that piece determines who wins. Now, all 10 are moving simultaneously toward the center. What happens when they collide? What happens to the price of that piece? It skyrockets instantly. This Arctic discovery announcement is effectively an alarm bell being rung across every defense ministry and energy company on Earth. It's going to drive governments to stockpile. It's going to drive industrial users to panic buy. And it's going to drive physical silver premiums to levels that make screen prices irrelevant. This is why we call it the catalyst that changes everything. But this catalyst is different because this involves geopolitical control, not just market forces. And the scariest part is, this announcement creates a self-fulfilling prophecy. The moment nations realize supply is concentrated in one contested location, they're going to fight to secure it first. They can't afford to wait and see what happens next. If China thinks America is going to secure Arctic access, China's going to move to secure it first. If Europe thinks either power is dominating, Europe's going to intervene. We're looking at a competition between the most powerful entities on planet Earth. And the prize is a finite pile of metal in one vulnerable location. You got to understand the psychology of this massive geopolitical shift. For decades, nations treated silver as just another commodity. They relied on global markets to provide steady supply. They believed they could always buy what they needed on the open market whenever. Today marks the official end of that philosophy completely. Today marks the beginning of strategic resource nationalism. They're acknowledging the free market failed to secure necessary resources for national survival. So they're competing, and when nations compete for critical resources, they don't do it with words. They do it with infrastructure spending, diplomatic pressure, and military positioning. This 2 billion ounce discovery is just the opening move, just the first signal. Once nations start fighting over Arctic access and realize how scarce supply truly is, the intensity will escalate. They'll spend whatever they have to spend to secure future access. And this brings us to the most critical question. Where are they going to get silver from? If they go to registered vaults, they're going to drain inventory to zero in months. If they lock up minor contracts, they're destroying the open market completely. There's no spare capacity in silver anywhere right now. Mines are declining, or grades are falling. Strikes in Mexico are shutting down production. So the world's superpowers are essentially announcing competition for a finite critical resource. This is the catalyst that changes the math from bull market to market dislocation, because you can't have a functioning global market when multiple sovereign powers are competing to hoard the underlying asset. The assumptions are dead. The banks who structured the paper system just got their reality check. The ones who promised unlimited supply to millions of contracts are staring at this data throwing up. They know they can't satisfy delivery obligations. How do you deliver silver when governments on multiple sides have mandate to acquire it? You can't. Defaults happen or prices explode. So while retail traders look at 93 on their charts, tectonic plates shifted beneath their feet. The price on screen is irrelevant because it reflects a market that existed yesterday. A market where governments were passive observers. That market's gone. We're now in the era of strategic competition for critical minerals. And if you think this is bullish, you're understating it. Bullish is when people want to buy something. Strategic necessity is when nations have to secure supply or lose power. We move from optional to mandatory, and supply simply isn't there. To understand how fast this accelerates, you got to look at physical premiums from this week. You got to look at numbers proving dealers are being overwhelmed before government even formulates buying strategy. We need to talk about premium expansion and physical drain happening in real time. According to reports from dealers across North America, retail premiums for silver coins jumped significantly this week. Let me repeat that so it burns into your memory. Premiums are expanding rapidly. That's not normal market behavior. That's a run on physical metal. That's massive volume of available supply being scooped up in days. To see who's buying you, got to look at dealer inventory reports and delivery times. This data tells you exactly which buyers are moving and how desperate they are. Reports from this week tell a story of absolute panic in the retail market. This week alone, dealer inventory across major channels dropped sharply. That means buyers said, I have cash and want to take delivery immediately. And who's stepping in to supply metal? Major institutions and smart money out of available inventory. Major dealers are watching institutional buyers dominate purchases. Do the math on that ratio. Retail is getting squeezed out. Institutional buyers didn't just participate. They were the market. They stepped in like a predator that smells blood in the water. And who's on the other side, desperately trying to maintain inventory? Local dealers are bleeding metal. They're the ones caught between retail demand and wholesale buying. They're frantically trying to find supply to satisfy customer demands. And institutional buyers are the sharks taking every ounce that becomes available. They're accumulating metal because they know what's coming. They know about Arctic supply constraints. They've probably already positioned before public announcement, so they're buying aggressively, knowing supply tightens from here. Now let's look at the timeline and scarcity math. The most important number in silver market is available physical supply. Available means metal in dealer channels actually obtainable by retail and industrial users. It's the only silver that matters for real-world transactions. As of this week, available supply at major dealers dropped to historic lows. That sounds like dealers always have stock right, how low is low. But compare that to the burn rate we're witnessing. We're seeing physical premiums expand and inventory vanish in days. If you take normal monthly dealer inventory and divide by current daily sales velocity, what do you get? Weeks, maybe 3 to 4 weeks at current demand rates. That's the timeline to critical shortage. And that's not prediction. That's arithmetic. If this demand continues, and we know it will accelerate because of geopolitical positioning, dealer inventories will be depleted by late February. There will be no more physical silver readily available for purchase. And what happens when dealer vaults hit zero? What happens when buyer walks in wanting to buy and dealer looks at inventory and there's nothing but empty shelves? It triggers a cascading effect written into the nature of tight markets. Price adjustment, scarcity premium, forced settlement at market clearing levels. They'll have no choice but to raise asking prices to ration remaining supply. They'll quote you prices maybe 150, maybe 175, maybe higher, and tell you to take it or wait. But by the time they quote those prices, smart buyers will have already bought at lower levels. You'll be left holding fiat currency while metal skyrockets. Subscribe to Market Pulse USA because this story is moving fast and the window's closing. This is Market Pulse USA. Stay sharp, stay informed, and we'll see you in the next one. But here's what most people are missing about the Arctic angle. It's not just about silver price going up. It's about how supply concentration changes who has power. When one region controls a critical resource, geopolitics follows economics. Right now, Greenland and the Arctic are becoming the new Middle East. Instead of oil, it's silver and rare earths and uranium all sitting together. Nations are going to position military assets in the Arctic. They're going to invest in infrastructure, competing to secure ports and shipping lanes. They're going to make deals with Denmark and Greenland that reshape polar politics. And every move one superpower makes, the other responds. This is how markets go from functioning to fractured. Because when geopolitics dominates supply, price discovery breaks. You don't get one global price anymore. You get regional prices. One price in New York, different price in Shanghai, different price in Arctic shipping nodes. That's already happening. Physical metal is trading at 130 to 137 per ounce in Arctic logistics channels right now, while paper shows 93. That $44 spread is not normal. That's proof the system is fracturing. That's proof real supply and paper claims are diverging. And when they diverge far enough, the paper market collapses. Banks can't force cash settlement when physical trades 50% higher. Traders can't accept cash settlement when real metal costs double the offered price. The system breaks through sheer mathematical pressure. Now here's the part that should concern you most. Governments and smart money have already positioned. They understand the timeline and the scarcity math. They're not waiting for you to figure it out. They're buying first, asking questions later. By the time average person realizes what's happening, supply will already be consolidated. Smart buyers will have physical, institutions will have contracts, governments will have stockpiles, and everyone else gets whatever's left at whatever price sellers demand. This is why we say, watch physical premiums like a hawk. They're the market telling you the truth. They're showing you real supply stress happening right now. Ignore the screen price, ignore analyst commentary, watch what dealers are quoting, watch how fast inventory turns, watch where premiums are trending. That's the real market communicating clearly. The second thing to watch is dealer delivery times. When delivery times extend from days to weeks, that's a warning signal. When it extends from weeks to months, that's a critical alert. Right now, some dealers are quoting 3 to 4 week delays on orders. That's not normal, that's market stress. Third thing to watch is who's buying and in what quantity. If you see institutions moving into physical aggressively, that's your signal. If you see governments locking up supply, that's your signal. If you see major miners suddenly defensive about production, that's your signal. These aren't speculation. These are hard facts you can verify yourself. A fourth thing to watch is whether paper and physical completely separate. The moment that spread hits $50+ and stays there, the market has spoken. It's saying futures prices don't matter anymore, only physical reality matters. Fifth thing to watch is whether exchanges start changing rules or restricting deliveries. That would be admission the system is broken. That would be them trying to prevent a physical run on the exchange. If you see that happen, you've got hours, maybe days before major moves. Now let me be clear about what this means for you. You're watching a system transition from abundance to scarcity. You're watching geopolitics move faster than markets. You're watching supply become a weapon. In this environment, decisions made this month and next month will determine your position for years. Do you own physical metal or paper exposure? Do you own silver, or are you short exposure? Are you positioned for supply disruption or betting on status quo? Because status quo is dead, it died when that Arctic report dropped. The only question is how fast the system reprices to reflect the new reality. And based on timeline math, it's weeks, not months. This is Market Pulse USA, and this is the moment you'll look back at and remember. Remember when you saw the signal and decided whether to act. Remember when the information was available and you chose what to do with it. Because in the next 90 days, everything changes. Subscribe to Market Pulse USA, drop a like if this resonates, and share this with people who need to see it. Because when silver prices move, the institutions that saw this coming move first. The ones who didn't, they get left behind. Stay sharp, stay informed, we'll see you in the next one.